hope you guys are good. Listen, happy Friday. Happy Friday. It's a good Friday. It's a great Friday, actually. And if you had a good week this week, I want to know about it. Share with me. If you never commented on a podcast before, you never commented on a video on YouTube or on TikTok or on Instagram or LinkedIn or wherever, or Spotify even, because you can do that on Spotify. Guess what? Let me know. I actually want to know, genuinely want to know how you are today. Because listen, Fridays are, I think, the world, or at least America, America absolutely loves Fridays. It's time to get out. It's time for the holidays. It's like casual Fridays. So good morning, and I'm glad that you're spending your Friday morning with me. And if you're watching this later on, guess what you can do? You can come over to YouTube, LinkedIn, Facebook, and spend your morning with me. Have some coffee with me. If you're driving to work, then listen, it's okay. You can put me on, and we get to chat here. You get to be right there with me as I get the drink, and we get to talk about whatever it is that I got to get off my chest. Because listen, there's a lot I got to get off my chest about this financial literacy epidemic. I was watching a video recently of a study that was just recently conducted, and apparently 40% of third graders can't read or are not reading at a basic level. That's crazy. And 21% of Americans are illiterate. I think that I would venture to say that there's more Americans who are illiterate. I mean, if you've literally seen anybody read something out loud, you'll learn and you'll notice real quickly that it's a lot more people. And I don't want financial literacy to be a part of that. And I get comments, and I hear it all the time from you guys. I hear from my clients, from business partners, from all types of people that, financial literacy isn't taught in school. Well, even when it was taught in school, it did nothing because people didn't pay attention, didn't have something tangible, didn't have a tangible experience to be able to connect it to. So because of that reason, I am going to be the one who goes out there and teaches everybody, I guess. I'm tired of that being an excuse for people not to get the learning and the education that they need. Tired of that being an excuse. So in today's episode, we're actually going to cover the next portion of the financial literacy pieces that I'm teaching. Basic principles of wealth building and of financial literacy, just basic principles, basic terms, basic definitions. On Wednesday, we actually talked about the first basic rule of money, which is how it grows. And we talked about compounding interest. We want to kind of recover that for you guys here today, actually. As long as I can get my things up. Give me a little bit of a transition. All right. So the last time that we were here, we talked about basic principles of money, and I'm going to briefly cover the stuff that we talked about last time, and that's only because, listen, last time I was drawing on a screen, but I was drawing on the screen directly, not on my presentation with Canva here. So you guys didn't get the chance to see. So I'm going to go over some of those quick examples just to recap, and then we're going to get into the next portions of everything that we covered. So last time on the podcast, we talked specifically about interest. We talked about debt interest versus growth and accumulation interest, and how the differences between those two are very minute, but in all actuality, they have huge impacts on us, right? As far as your debt interest, when you have interest, this is the amount of money that they're going to charge you extra. We didn't dive too much into why and things like that. We'll get much more into that on another day when we dive into banks and how banks ultimately use interest and whatnot. But as far as the last time we talked about the debt interest stacking, right? Versus your compound interest on like your account and being able to actually grow. And it sucks it truly sucks so much because we don't think about our interest and our wealth in terms of our overall net worth. We don't think about it in our overall net worth. You're not hedging enough against your debt interest by trying to grow money and trying to grow interest. As an example, if you've got $500,000 of debt at 6%, you might have, let's say you've got that might take you 30 years to pay off. You might end up paying somewhere of an additional $300,000 of debt in interest. Excuse me. You end up paying $300,000 extra in interest, right? Now that's crazy. That does sound absolutely crazy, but this happens all the time, right? All the time. That's a lot of money just going to waste essentially on interest. But this is debt interest, right? That's debt interest. When you start trying to grow money, you start from zero. And if you start putting in maybe $100 a month into an account that's growing at, let's say you get a high yield savings account that's growing at 4%, you're getting only 4% on $100 and then whatever else continues to grow. You are severe, the amount of interest that you're gaining, it nowhere near even touches the amount of interest that you're gaining on debt. And so when you think about interest, when you think about your money and your wealth, more money is being thrown away, especially if you are choosing not to, if you're choosing not to even save money into an interest-bearing account, whether it's high yield savings accounts, the market, indexing accounts, IULs, things like that. Like if 401k, if you don't have money hedging against this, you're wrong. The reason why debt is so horrible on us is because of the fact that when you start with debt, you start with a large amount of money, right? Even if you just take out a loan, like a small loan, $5,000 loan, how often do you start with a $500,000 or a $5,000 loan at 1%? Not often. Yeah, not often, right? It's going to be up higher. But can you just put $5,000 in a bank account, in like a high yield savings account, and make good interest? Yeah, 4%. You make 4% on that potentially on that $5,000 per month, right? And that's awesome. But that still doesn't outweigh the 12% interest that you're going to have on that $5,000 loan. So you have to understand the money that you're putting anywhere means that there's money coming from you elsewhere. It does. And you're paying interest, and that's not even keeping up with the interest that you're making. Excuse me, the interest that you're making isn't even keeping up with the interest that you're paying. So you're almost just biting yourself in the foot. So this is also another reason why we talk so much about interest. Also, we also talked about the difference between simple versus compound interest. And when it comes to simple interest, pretty simple, very simple. Let's say that you put $100 in an account growing at 10%. Growing at 10%. In simple interest, you're always going to earn, it's a promise that you're going to earn whatever the interest rate is on your principal. On your principal. Your principal is the amount of money that you started in the account with or that you put in the account. So you're always going to earn 10% on the principal, meaning you're always going to earn 10% on $100. So in this case, let's say this year happened, right? You made 10% on an account. That's an additional $10 added to your account, meaning that you're at now $110. Once again, the next year happens, 10% on $100. So that's gonna be another $10. It just means that you're gonna earn $10 in this account every interest, whatever the period is that they credit you to interest. So this would eventually go to $130. After 3 rounds of interest crediting, you'll be at $130. The difference between this and compound interest is small up front, but makes a huge difference. Compound interest, what happens here is, let's say you put $100 in an account at 10% interest. What happens here is you're going to earn 10% of whatever the current account value is, not the principal, the current account value. Meaning, right now, if the account value is $100, you're going to earn $10. This is going to put you at $110. Simple. Now you're going to earn on the new account value. So 10% of $110 is $11, which now puts you at $121 in your account. Do that once again, you're now at $12. So this is going to bring us down to 132.1, like 10 cents. So after three interest crediting times, you're now at $132 versus $130 with simple interest. Now, again, this is really small now, but when you're looking at tens of thousands, hundreds of thousands of dollars, when you're looking at years, 20 years, 30, 40 years, this makes a huge difference. And you want to have these sorts of accounts. There's not that many accounts nowadays that are simple interest, like in the form of just like being able to grow, some interest on your account. But there are some that still exist in different ways, whether it's debt interest or some wealth accumulation, some growth accumulation style. And then the last thing we talked about in this section was the rule of 72 and understanding just how fast that money grows. Because a lot of people, they put money in different places or they buy certain financial products and they don't really know what's actually going on, like how long it's going to actually take. Like, we start with these accounts, but we have no clue what they're actually going to do. Okay, we have no clue what they're, we know how they work, but that doesn't mean you know how how it's going to perform or what it means that it can do. As an example, you've got money in a 401k. Can you tell me exactly how much on average or estimated how much money you're going to have in your 401k by the time you retire? Then can you also tell me how much money you're going to be able to take out in retirement? Do you have that estimated? Do you have it calculated? Outside of life's unpredicted stuff, right? Like you getting, majorly sick, knock on wood, you're getting majorly sick and needing to take from your 401k, you have maybe long-term care or living benefits, life insurance. Outside of those things, right? Like, can you tell me how much you have in that account by then? Can you tell me if your grandparents, bought a U.S. Treasury bond? Can you tell me how long it's going to take for that money to reach however much money it's going to reach? Or did you just set it up, put money in, expecting that it will do what you hope that it's going to do and pay you for the rest of your life? The rule of 72 solves that for you, at least by average interest, right? So the rule of 72 tells you if you take whatever interest rate you're earning, so let's just say, as an example, 4%, you take whatever interest rate you're earning, divided by 72. Oh, crap. Okay, that's a highlighter. Divided by 72, it'll take approximately that many number of years for your money to double one time. So the example that I want to give is the fact that, like, our grandparents, they a lot of times, like our grandparents from years ago, they were buying U.S. Treasury bonds, and U.S. Treasury bonds, hey, they're fine. But they put money into them expecting that they're going to grow. And a lot of times they're going to buy it when you're first born. And the expectation that they always say is this will be your college fund, because they expect money to grow really well. And if they put, in this case, a U.S. Treasury bond, they buy a U.S. Treasury bond at $500, and you said it, in their mind, they're thinking this $500 is a lot, is going to grow massively. A lot of times, especially like when you're broke, when you're poor, that $500 is a lot of money to put away for in 18 years whenever the kid is going to college. But U.S. Treasury bond average is around 4%. I think it's like 4.16, but around 4%. So that means it's going to take 18 years for this money to double one time. So in 18 years, if she bought it or grandparents bought it when I was a brand new born, 18 years is finally going to double to $1,000. on average. And in my case, that's actually very true. Yeah, that's not enough for a college fund, right? Especially if we're talking 4 years of college, if we're talking 4 whole years of college, right? Let's just say $80,000. $80,000 for tuition, right? That would mean we would need it. My grandparents would have need to put in $40,000 to buy a U.S. Treasury bond to have doubled by $80,000 by the time I was 18 years old. Who's buying U.S. Treasury bonds for $40,000? Nobody. Now, granted, there are some people who get 529Bs, but ask yourself the same exact thing. What is the average interest rate and how much money you're going to be putting in? And you should be able to identify how long it's going to, or exactly how much money you're going to have in that 529B by the time your kid gets to that point, right? As an example of a lot of people are starting with like $100. Let's say you do $100 a month for 18 years. Now I'm going to do some math. 12 times 18, $21,000. $21,000. You better hope that it grows. You better hope that it grows very well, because that's 1 year of school. That's 1 year of school, as long as the market isn't bad, right? Now, how can you identify? Because sometimes the Rule 72 doesn't work, obviously, when you're putting money in. Go to moneychimp.com. They've got a great calculator right here, compound interest calculator, so that now you can identify how much it'll actually grow with an estimated average interest rate, right? So current principal, 0, right? 0, because you don't have any money when you started off, unless you do, then whatever. And then you put in $1,200 a year, right? $100 a month. Years to grow, 18 total years. Let's say that the 529B is growing at 4.5%. Calculate, you have about $33,000 in the account. If it grows at average at 4.5%. Let's say 7%, $43,000. And let's say if you somehow magically you were able to get like a 12% average growth every year. This is every single year, right? $74,000. Now, for those of you who want more accurate estimate, you can go to investor.gov. They'll give you, if you come over to financial tools and calculators, compound interest, they actually give you a much better understanding of everything. Initial investment, $0. Monthly contribution, $100 a month. Length of time in years, 18 years. Estimated interest rate, we're going to say 4.5%. Interest rate variance, we're going to go interest rate variance of 3%. This means 3% above, 3% below. Actually, let's go 6%. 3% above, 3% below, compounding annually. And this is going to give you that average. So in 18 years, you have about 37,000. If it is at 6%, right? And this will also give you the variance. So depending on how the account performs, if it performs down from at 3% right here, you'd be at about 28,000. And at most, if it performs at 9%, $49,000. So you can be able to kind of tell from here based on how the account will actually grow with compound interest. Again, you've got a very simple calculator here with moneychimp.com. And then also you've got investor.gov, financial tools and calculators, compound interest calculator, and then put all this stuff in. So that's the stuff that we covered last episode. That's what we covered last episode. If you have not watched that, definitely go back and watch it. But this was just mostly a good little recap for you to be able to get caught up on where we are today. Now, we also did briefly mention or briefly talk about we gave some of these examples of 4 versus 8 versus 12%. But we did get into talking about actual accounts for your money to grow. Because like, obviously you're not going to just find like, we all want 25, 100% accounts, right? We want all the accounts that we can at the highest interest rate, but not all accounts you're going to find that with, right? And not even all accounts do you even want all of your money in, right? As an example, you don't want your money, your emergency funds sitting in a 12% account. You don't. That money's just going to get probably taken away from you somehow due to the market. It's going to be locked up away somewhere that you can't access. So you don't want your emergency funds in a 12% account. Yeah, I said it. You don't. You want your emergency funds in a very low growing account. Now you want it in a 4% account. You at least want it in a 4% like high yield savings account, so that way it outpaces inflation. But if you were to be putting your emergency fund somewhere and they're like, hey, we're going to give you 8-9%, that's not where you want your emergency funds, because it has certain other features. Different accounts have different implications on them, upsides and downsides, and you need to understand where to put that money at. This coffee is so good. All right. So let's go ahead and dive into the 3 types of ways, or the 3 patterns for which money grows. We talked about this briefly last time, but I want to dive a little bit deeper into these, about the reasons for these, the uses for these. So when it comes to 3 types of patterns for your money, you've got fixed, variable, and indexed. And these 3 patterns, as you can see, fixed, pretty slow or pretty small, not like any kind of much growth at all. Variable goes up and down. This is obviously the market-based accounts. And then you got index, which are market linked or indexed growth, meaning that it is segmented where it doesn't ever lose any money. It never takes losses, but it is mirroring the market. So you get to take chance to take part in the upside of the market. Now, the 3 parts of these different accounts are so very necessary. And a lot of times I see people, a few different situations. One, they've got all the money in one of these 3 buckets: fixed, variable, or index. Actually, most of the time, when I meet someone, they don't have any money in index. There's only been one person. And that one person, I'm going to give an example here shortly. But other than that, they've either got all their money in fixed accounts or all the money in variable accounts. I talked about this on the podcast before. I talked about fixed, variable, and index when it comes to your income, and how your income can be fixed, variable, or index, and that you should have multiple sources of income. If you want to build wealth, you should have multiple sources of income. You should. And not just multiple sources of income in the same pattern, right? You should have fixed, variable, and indexed income. But when it comes to your account's growth, you should have fixed, variable, and index. Now, when it comes to fixed accounts, the purpose of fixed accounts is for emergency funds. You want fixed accounts for emergency funds and emergency funds only. That's pretty much it. Reason being is because these are safe and they also have low growth. Safe, but they have low growth. You might get up to, in a good year, up to like 5.5%, right? High yield savings accounts are held with banks, and they are fixed accounts. Yeah, high yield savings accounts, their interest rate goes up and down based on how like the overall market and the economy is performing. Yeah, that's true, but it's not a variable account per se. Variable account, like the interest rate changes, but the interest rate itself is still fixed. It's telling you what you're going to get, right? Versus it being variable and you not know what you're going to get. That's the difference, right? Variable versus kind of flexible, right? High yield savings accounts are more flexible based on the market versus variable based on the market. So you might get up to somewhere up to like 5.5% on a high yield savings account, which would be great, right? Right now, on average, they're mostly around like 4%. They're mostly around 4% right now. Most high yield savings accounts are. So this is where you want your emergency funds. Reason being is because if you have, let's just say you've got 3 to 6 months of an emergency fund, right, of your monthly expenses, right? The reason you don't want to have more than 6 months of emergency funds put into a safe but low growth and liquid account is because let's say your emergency fund need is like $18,000. You need $18,000 of an emergency fund. That's going to be your 6-month emergency fund. But you've got $50,000 saved up. You got $50,000 saved up. That is that's $32,000 that you have sitting in an account that you don't need there because you've got 6 months. Typically, if something happens to you, it'll probably take about 2 months of your expenses, right? And then you recover after another month. That's why at minimum, I say like 3 months. And there's some people out there that say just $1,000. You need much more than $1,000 in your savings account. You do, like you and your high yield savings accounts. You do. This like idea of most Americans have less than $1,000. So yes, it is great to get to 1,000, but you need 3 to 6 months of emergency fund. If you don't expect any kind of financial changes in your life, then 3 months are fine. But whenever there's financial changes that are about to come up, you need to start increasing up to 6 months prior to, so that by the time there's a change, you're at 6 months, just in case something happens. And that can be financial positive things or financial negative things, which it doesn't matter. But you want to have it in a high yield savings account because it's going to outpace inflation. Now, outside of outpacing inflation, all this extra money right here could be that $32,000 could be growing in accounts at 6%, 8%, 12%, 15%. But instead is getting very minimal growth when it should be growing elsewhere for you. So you only want to use these fixed accounts specifically for emergency funds and just to make sure that your emergency funds are outpacing inflation. That's it. That's it. Other than that, you don't need them. You don't need them. Moving on to variable accounts. So we also talked about variable accounts last time. Variable accounts are going to be like your stock market accounts, your stock market account. They're going to be your mutual funds, your ETFs, all of those, right? There's my pen. There's my pen. Yeah. So these are going to be your stock market accounts, mutual funds, and so on and so forth. Now, the great thing about variable accounts is that they have amazing growth potential, awesome growth potential. You get the chance to really gain a lot of really good money or wealth sometimes in those accounts, especially if you're smart, if you're knowledgeable, right? You've also got options trading here. You've got crypto. And these are all really great things that you can be able to put your money in. And with this, if you know how to properly trade, manage, you know how to look over your accounts, these can be great for you. Absolutely great for you, because you do have the chance to turn a little bit into a whole lot, into even more. But the downside is the fact that there is downside risk, which is what most people are afraid of. Why most people won't invest money. Why most people won't invest money. Now, the biggest issue that I see with this is that most people don't know or don't understand. Okay, cool. I just want to see how thick that was. Most people don't understand that their retirement accounts are here as well. Their retirement accounts are here as well. So your 401ks, your IRAs are also here. 401ks and IRAs are also directly invested into variable accounts. I don't believe that your retirement should be entirely gambled. I truly don't believe that. So that's the other thing, because when we think about our accounts and our growth, you kind of have to think about it differently, because so many people don't think about the distribution phase, but they only think about the accumulation phase. And this is where variable accounts mostly shine, is in the distribution phase. In the accumulation phase. So what I mean by that, there are 2 phases to financial planning overall. Two total phases to financial planning. One is the accumulation phase. And the second is the distribution phase. Now, with this, The accumulation phase is where you are accumulating money. This is the time between when you're 18 or when you start working, 18 to whenever you start to retire, let's just say 65 years old. This is the accumulation phase. This is where you're trying to grow as much money in your accounts before retirement. That's it. Pretty simple. You're trying to accumulate as much money in your accounts before retirement. That's why we work. That's why we start businesses. That's why we do all these things. We save money into all types of accounts. Everything you do when it comes to money, everything, the money that you spend, the money that you invest, everything is a part of the accumulation phase before retirement. So every little thing that you do, you're taking away from your accumulation phase if you spend it, right? Versus the distribution phase is when you decide to retire. So let's just say age 65 plus. So this is where you're pulling money out. Now, obviously in retirement, you don't want your money to stop growing, but money does stop growing typically. And I'm going to talk to you why. Because when you have variable accounts, I'm going to draw on this sheet. Bam. Okay. All right. So we're going to talk about this and the accumulation phase. Accumulation phase. So in your accumulation phase, you're putting money in, money's going up and down. Things are all over the place, right? The hope is that you have general growth from here to here. This is the hope, but your money's going to go up and down. It's going to do all types of crazy things. But this is the accumulation phase. This is age 6 or 18 to age 65, right? And the hope is that your money ends up here, right? That's the hope. This is everything in the accumulation phase. So if all of your money is directly in variable accounts, this is what's going to happen. This is what's traditional. But now here's my next question. And this is what I want to ask you. If instead I did this, distribution phase, this is age 65, and this is age 100. But instead, if I did this, would you be okay with this being the pattern of your retirement income? Where now you're pulling money out, and so that way you can live. You can take income every month or every year so that way you can live. Would you be okay with this? No. The reason being is because let's just say this is when you are 70 years old. The market is down. Do you want to take money out of your market-based account when your account is down, negative? When the market is down? No, because one, the market's down, so you're already going to have to fight to get back up to where you were. And two, if you take money out in this year, you literally just locked in these losses forever. Would you want your account to be down here? Definitely not. Yeah, would you want your account to be up here? Yeah, sure. It doesn't really make any difference because you're going to be pulling money out anyway. But in any year, you want to make sure that you have money in your account. So nobody ever thinks about the distribution phase when they're planning their money up front. They only think about the accumulation phase, but you have to think about the distribution phase as well. So what typically happens then whenever someone gets to this point? What typically happens when people get to the distribution phase? So what typically actually happens when they get to the distribution phase is they will bring all of their accounts down to about 1 to 2% accounts, so that their money is kind of just like this. That way they're never taking any losses. They're almost never taking any losses. They move into very low risk accounts, and then they just take income out there from age 65 till age 100. This is what typically happens. And they'll just take money out in these years so that way they don't lose any money. This sucks. Reason being is because now your income stops growing in retirement. But this is also only because you didn't plan up front. You didn't think about up front what your money is going to do in distribution phase. You and your advisors only talk to you about your money growing in the accumulation phase. And then when you turn 65, now they're like, or just prior to, they're like, okay, let's go ahead and bring it all down to low risk, so that way you don't start losing money in retirement. And that's horrible. Why would you want your money to basically stop growing? But this is because most people only know about variable accounts. They only know about variable accounts, which does nothing but harm you if that's all that you know. So you have to understand, you have to start planning, right? Like I said, variable accounts, fantastic for the accumulation phase. You want to definitely have your money there. Have some money there, but not all. And that's where index comes in at, because indexing provides safety and stability. It's a good balance between safety and growth. You want your money to be safe, right? You don't want to lose that much money, but you also want to maintain growth. Now, in index accounts, remember, as I talked about last time, an index, like an index fund, let's say like the S&P 500, right? You've got the NASDAQ. I can spell it. If I can spell it. You got the S&P 500, the NASDAQ. You've got like JP Morgan, so on and so forth. New York Stock Exchange. You got a bunch of different accounts, right? You got a bunch of different. These are all safe, predictable accounts, right? These are indices. They are a conglomerate of Fortune 100, 500, 1,000 companies, right? They're much less volatile, so they don't have crazy years, right? Like you're like the S&P 500 is never really going to have a crazy year. We know on average the S&P 500 is going to do well. It's going to grow. We know it's just going to be good, safe, consistent growth. That's why so many people say invest in S&P 500. Now, these accounts are still variable, right? They're still variable because it goes up and down, right? It's still based on the market conditions. It's still based on volatility and so on and so forth. However, what I'm talking about is you can mirror those accounts instead of having your money directly in there, which is what provides the safety. And you're also going to get that same growth, that same average growth with money that is linked to the stock market. But you don't lose anything when those accounts are negative because they're not actually directly in the accounts. So since they're not directly there, you don't take any losses. But since they're also only hedging or mirroring indices, you don't have crazy growth either, right? You're never going to have like an Apple launch and now you potentially just had a 300% year. Like that's not going to happen in an index account, right? So you're not guaranteed. You're not going to get as high as returns, right? In any random years. That's why you for sure want variable accounts. But when it comes to index, it will provide safety for you. So this is a great place to be able to have money both in the accumulation phase and the distribution phase. Reason being is, let's just say that I'm going to go ahead and change this back up. Let's just say that this is your accumulation phase. Age 18, age 65. And let's just say instead, you don't need to actually reduce your risk all the way down to that low, right? Actually, accumulation, we're talking about accumulation. But this is variable, obviously, right? And then this is indexed. My drawing is on point today. And then this is index. No, stop that. I don't want you to do that. All right. The good thing about this is that if the stock market is up, one cool thing that you can do, depending on your types of accounts, you can take money from your stock market accounts and bring them over, drop them into your index accounts when the market is really up. Really cool. When the market is negative, you don't have to do anything, right? You don't have to do anything. You don't even have to worry because you've still got money that is protected, that didn't take any losses to the market. And then whenever the market starts to go back up, you get all the upside in your index account and you get the upside in your variable account. The likelihood that your variable account is going to grow higher, it might be slim, right? You might get like a 20% growth or something like that versus maybe like a 15% growth here. But you didn't ever have to worry about the loss, right? This is so very important, especially once you get into the distribution phase. And what I mean by that is, even though when people are in the accumulation phase, and they have both of these accounts, they're able to take more risks in their brain because they're like, well, I've got one account that's safe and that's protected. So let me also do a little bit more risk because I might be able to gain a lot more money. But when we get to the distribution phase of life, where we're now in retirement, this becomes even a more crucial strategy to understand. If you choose to. So I've got some people out there who in their distribution phase, they want all their money protected. They don't want to lose any money at all. So after teaching them about indexing, they just say, hey, in retirement, I just want all my money in indexing accounts. That's fine. Some people, though, they still like the risk. So some people, maybe they'll bring their account risk from like 9% down to like 6% or something like that. So they can still get average growth around 6%, right? But they're okay with this in the age 65 if their account is like this, because they know that, let's say their accounts are up. I'm gonna go purple. Let's say that their accounts are positive, right? Age 65, they take money out. Age 66, they take money out. Age 67, 68, 69. But then 70, it starts going down. When they're 70, instead of taking money out when the market's going down, they actually take money out of their index account because they don't want to take money from an account that's losing money and locking in those losses. So now their account goes down, but when the account starts to go back up, then they start taking money out again, 78, 79, 80, 81, 82 years old. And then once again, the market goes down for a while, for like 5 years. And they just take money out of their index account that might be having some growth. And this prolongs the retirement strategy because they planned up front to have both. And again, some people just say, hey, like at the end of my, at the end of my accumulation phase, go ahead and move all my money into index accounts for retirement. So that way I just got all my money there. Because again, there's really no bad thing here. The only difference is that you won't get some random growth, right? So whichever strategy, you need to understand and think about up front and ahead of time. But again, basic financial literacy like this just isn't taught on how to use all three types of accounts, especially for retirement. So this can be, actually, let me pull this back up. This can be 401ks. It can be IRAs. This can also be just regular brokerage accounts, right? Just regular like stock market accounts, mutual funds, or anything like that. Now, again, if this is 401ks or IRAs, then yeah, you'll be able to do this properly because it's a retirement account. But if it's just stock market accounts, whatever, you can still have money in a stock market, and then take that money and move it over to an index account, or use it, take income out, or whatever the case is. So that is index accounts versus variable accounts, the differences and why you want to use them. So as I said before, fixed for emergency funds. Three to 6 months of emergency funds in these accounts, and you for sure want high yield savings accounts. Again, I've got a high yield savings account podcast episode already, so if you want to check that out, just go look from about a year ago. You guys can be able to find that. Variable accounts, just great in the accumulation phase. Now, I don't believe in having my entire retirement plan very gambled. So to me, my if I had a 401k, I'm definitely moving that into an index account. If I have old 401ks, I'm definitely moving those to index accounts. If currently I have a 401k at my job, I'm not moving that into an index account. I'm not moving it to an index. Yeah, you can't because you don't have the ability to take in-service distributions. But if I've got an IRA, I'm definitely cycling money into my index accounts like every 5 or 10 years consistently, because I'd rather have my retirement plan set up with indexing, and that will allow me to use more mutual funds, stocks, and things like that. Now, in the accumulation phase. So I'd rather have this for accumulation for some random growth, and then my index accounts are specifically my retirement strategies. Specifically my retirement strategies for protection. So that way I already have, I've already got money that's always growing, and that's also safe for me. One, and I've got a bucket to be able to put any extra random growth in that I have during my accumulation phase. If I got a bunch of random growth, I'm going to be able to take that and drop it into my index accounts, or grab different types of index accounts, right? Fixed emergency funds, especially in retirement too, because if you got your emergency funds in retirement, you don't have to take money from your 401k or your IRA or your index accounts, your IULs or your fixed index annuities. You don't have to take money from those accounts. If you get sick, injured, or ill, hopefully you have long-term care and you have the right types of insurances, life insurances with living benefits. Health insurance is health insurance is, So hopefully you do, because then in that case, you have really good growth, hopefully while you're in the accumulation phase, and also really good consistent growth with no losses as well here. So those are the 3 types of accounts that money grows in, and how you should be thinking about and looking at them, especially now, in the future, and when you're also retired. The next thing we're going to dive into are the tax buckets. The tax buckets and where you put your money and how that actually has to do with these types of accounts, and also the way that money grows. And then afterwards, we're going to dive into money management skills. We're going to dive into financial foundation pyramids, and also dissecting accounts. We've got a lot of stuff to cover over the next few weeks. So with that being said, if you've learned anything from today's episode, today's very, very, very educational episode, let me know. I love doing this, because once again, this season is all about getting things off my chest. And sometimes I got to teach you guys, since I hear the excuse all the time of financial literacy is taught in school. Okay, well, it's right here for free, straight up out there. Whatever questions that you might have, I can provide them. I'll answer them. Shoot a comment, and I'll definitely respond. I'll reply. If I don't reply with a video, then I'll reply with just a message. And if you have any kind of questions, or you specifically want to sit down and learn more about very much your situation and what's going on in your life with your finances and your future, or you got family and friends, there are links in the description of anywhere where you can enjoy our podcast to be able to sit down with anyone in my finance firm, and they will work with you completely complimentary. Just let them know that I, Charming, Success Blueprint, whatever, that you found me from the podcast, and they will give you the royal treatment. So With that being said, happy Friday. I hope you guys have an amazing weekend. Be safe out there because listen, it's not always a safe world out there, but I wish you good safety and enjoy. So enjoy your weekend. I will see you guys on Monday and have a good day. See you guys.